Chegg specializes in providing students the assistance they need to really learn a course, a topic, a subject. They've been a fairly popular application, especially around the COVID years, where students were asked to leave the classroom and learn online through Zoom classes. That's when the company had a real rise in subscriptions. Now, the company has really struggled to keep their user base high. In fact, they're losing subscribers. As a result, they're losing revenue. Is this company going to make it, or are they going to eventually be a zero value company? I'd like to take a look at this stock and see what I think is going to happen. Chegg is a well-known company to many students, and I was able to ask my son, who's a student now and actually is a Chegg subscriber, independent of my decision on this stock. And he happens to believe that it is worth having a subscription because Chegg provides really precise information to a student. I'll take his word for it and use that as part of the data set that I use as I make decisions on this company. I'll take a look at the fundamentals and try to forecast where this business is going and see if it's worth an investment. This is a high risk stock. It's been in a free fall, but it certainly is discounted. If this company makes it, it's going to reward shareholders. Now, I'll take a look at fundamentals and let you know what I plan to do with this stock. I currently own a few shares. I'll make a decision whether I should buy more shares, hold, or sell my shares in Chegg. Let's get into the fundamentals. The Chegg stock has really seen a big high, and now it's trading for $2.22. During the COVID years, it was trading as high as $100 per share. Now it's had a big drop, about 97% from the high. The company has a market cap of $226 million. The revenue is $683 million. This is pretty much a company that's being viewed as a company that's probably not going to exist. The big threat is AI to Chegg. And I'm going to have some comments on AI as the company has really retooled and put out an AI application themselves. That might be a real big opportunity if they can make it work. Earnings per share, they've been losing money, but their forward PE is just 2. Again, this company is so discounted. Analysts believe that it's highly discounted, 168% discount. That's the highest discount I've seen on stock analysis. It's pretty amazing. But it really is a case of, most people believe Chegg is probably not going to exist. They're probably going to be replaced by ChatGPT or Google Gemini or even Meta AI or one of the other large language models. And one has to think, are those large language models going to give students the precise information they need and the assistance they need to really learn a topic and get a good grade? I don't know just yet. I do use Gemini, ChatGPT, and even Meta AI, and they do provide good information. But I would also say when you ask a precise question, sometimes it comes back with a very general answer and it's not very useful. I think if Chegg outperforms the general large language models, there'll be a real need for Chegg AI as well as the human to human based support that Chegg can provide. Those things may still be relevant. It may enable the company to begin to grow and be around. If Chegg makes it, I think it's going to be a big, big win for current stockholders who could see their shares rise because you're starting with such a low stock price. Revenues for Chegg have been declining in recent years. And if you look at previous years, they were really growing, especially the year of COVID. Everybody needed Chegg to get through classes, but they've seen their revenues decline. And unfortunately, the latest release shows that there was a significant decline in revenue and in subscribers. So I'll take a look at that more closely in the earnings. The cash flows of the business, they've been a good cash flow business, but the cash flows are also slowing down, which is concerning. They were cash flowing really well in the years of 2020, 2021, all through 2023. The cash flows have dipped in the trailing 12 months, and the most recent quarter also went down significantly. So all the things are headed in the wrong direction for Chegg. Revenues are down, free cash flows are down. Also, debt is rising a bit, and their cash balance is still good. But overall, things got to turn around soon, or this company is really headed to a point of no return, and they may have to kind of fold up at some point. 9 analysts cover Chegg, and the price predictions are all over the place. One analyst believes the stock is really worth $10 a share, and the worst prediction is at $2 a share, which isn't too bad. It's already at $2.22. Overall, on average, analysts believe it's discounted by 168%. Their earnings per share is expected to be okay. It's going to be a little over $1 for the next 3 years. Just using that rate, the stock is highly, highly discounted just because you have a profitable company that is cash flow positive, generating earnings per share. They should get at least a 6, if not a 12 EPS. But the sentiment on this stock is so low that it's really being discounted. The earnings report for the second quarter of 2024 are out, and it does show concerns that the company revenues year over year have decreased 11%. That's not good. The encouraging thing is they're in a high margin business, gross margin of 72%. That is good. They do have positive EBITDA, adjusted EBITDA, and they did have net income. It's non-GAAP, but that's what really counts as non-GAAP net income. The subscriber growth, it was negative, and that's a problem. If we look at the guidance they provided, I think that's why the stock tanked so bad a couple of days ago, is that they're actually guiding that the revenue is going to drop even further. And if they can get to a point where they can just start growing, if you compare one year to the next, I think that'll stabilize the company, if not cause the stock to rally. They do expect that they're going to have positive EBITDA. They are going to have very good gross margins. These gross margins are very good. This is an industry and a business that really drives high margins, which is one encouraging thing about the company. The balance sheet looks okay. They have a fair amount of cash and short-term investments on their balance sheet. So that's good because you're going to need that cash to get through this reimagining the company and reinventing it to be an AI company. The debt level isn't rising, which is very good. You don't want debt to rise, especially in a company like this. They have enough bad news and problems to deal with. Looking at their statement of cash flows, the company did produce positive cash flows from operations, and they did have CapEx. It's expected that they have CapEx. They're probably spending quite a bit on the AI business, which is understandable. It's good to see that they have positive cash from operations and positive free cash flow for the first 6 months of 2024. I ran a valuation on Chegg, and as you can imagine, it was a little tricky to get the right forecast for cash and really think through this one. And the reason for it is the stock price is so discounted, it almost makes the numbers unbelievable. Let me take you through it. Overall, I'm showing that the company is highly discounted. I'm agreeing with those analysts that had that huge discount. The principal reason for it is they are profitable. And if I use a PE of 12, it gives me a discount of 483%, especially if they make it. And they make it and they start growing. This stock's just going to really rally up to $10 a share, if not 12, very quickly. And right now it's trading at $2.23. So it really is an opportunity. If if one believes that the Chegg business is going to work and at some point they're going to start growing, that AI business is going to become something, this might be a really interesting stock. The cash flows, they support a number as well. If I just have a reasonable forecast on their cash flows, I get a small discount of 21% if I use a 12% discount rate on those free cash flows. So overall, it's a highly discounted stock. One thing I would put out there is Chegg could be an acquisition target, another business that really wants this AI model, this AI business, and frankly, access to all those student accounts that they have can very quickly buy the company at a very low price. Maybe one of these bigger companies that already has a big AI model, let's say a Microsoft or ChatGPT or a Google or Meta AI or one of those big giants might acquire this company and very quickly have a lot of subscribers to the AI model. We'll see what happens, but it's a highly discounted stock. The real question is, do you think they're going to make it? Do I think they're going to make it? That's the big question. In general, how desirable do I believe the Chegg business is? And I prefer to have really desirable businesses that are operating in the green quadrant that I've put together. These are companies like Google that have a search engine that is unrivaled and has great competitive barriers, keeps competitors out by being just the dominant search engine. Now, Chegg does not have just an exclusive operation within this market, but it was for a while highly desirable. It's really a company that belongs in the gray. Now, if they make this AI application work, I'm going to dip them in the green a bit, but for now, they're going to be in the gray. And for a company in the gray, I really want a high discount, which they offer. Now, companies in the red are typically companies that are in old industries that have very low margins, highly competitive, and that's not Chegg. I know that AI is a big threat to Chegg, but AI might be the biggest opportunity they've seen. And if they can make that work, this stock might quickly be a 5, 10, $20 billion company market cap. If that's the case, your money would be 10x, maybe 20x. So it might be worth the risk. Having said that, I'm going to buy additional shares of Chegg on the principle that the risk that I'm taking is more than being compensated in the potential reward. The rate of return on an investment in Chegg could be really high. And I don't know that there's a ton of risk since they are cash flow positive, they are profitable, seems like they're making the right decisions and trying to build an AI business while trying to keep their existing business active, since a lot of students really depend on it. Overall, I do like the business. The situation they find themselves in is tough, but I think they're making the right decisions. The balance sheet's in good shape. They have almost as much cash as they do debt. I don't want to see debt grow. And the discount is massive. So overall, I'm a buyer of Chegg. We'll see how things work out with this stock. So that's my evaluation of Chegg. I hope you found it interesting. Let me remind you, I'm an investor. I don't make any recommendations to buy, hold, or sell Chegg. I don't provide any financial advice. Thanks again for watching. Good luck investing in 2024.